Hello and welcome to the first of my podcasts. I'm Mayor Plancy, Director of Witham Finance and Plan Funding, companies that deal with professional landlords, complex cases, and anything in between. If any of you have read any of my LinkedIn posts, I give snippets of information about deals that we've done, questions I'm asked, etc. But what I did find over the last few months is a number of people have asked specific requests about specific deals. And I wrote a specific podcast about free advice. You know, I'm all for it. The information's out there. There's no reason why we can't help one another. So came up with this idea to try and bring the industry gurus to the forefront and give snippets of information with their infinite wisdom and hopefully help and educate us all in the process. So thank you for joining us. And fortunate for me, I'm in safe hands because I brought on board Alex Witham, who's our business development manager for Landbay. And Alex has been instrumental in working with us to get to the volumes that we're doing. His knowledge is second to none, and he's a all-round, generally a good bloke. So welcome to the very first podcast, Alex.
Hi, mate. I'm delighted to be the honorary first guest on your podcast.
Thank you. At least I'm comfortable enough that if it's a train smash, I can solely and wholly blame.
You can blame me. Yeah,
absolutely. Okay, so a few of the questions that have come across over the last few months, and I want to pick your brains. First of all, I think it's probably the more general. In general terms, what's the market like? So for the professionals out there, you got an insight firsthand. What do you see? What's your insights to it?
It's been somewhat of a tempestuous market, certainly since the mini budget at the end of September. I think 23rd of September was Judgment Day for that. Of course, that shook the market. Interest rates spiked significantly, which caused a degree of panic for both lenders and investors, buy-to-let investors. But what we have seen is the interest rates reduce quite significantly in the aftermath of the mini budget, and what that's done is restored some market confidence. However, I do think that we're kind of at a bit of a tipping point, really. Some of the smaller amateur landlords may be looking at their portfolio, their properties. Perhaps they've owned them for quite some while, and looking at the increase in interest rate that they're now experiencing versus what they've been used to for the last 10, 15 years. And they're making decisions as to, do they keep, do they incorporate, do they sell? What I think that some who are in that pool will decide for a combination of Section 24 tax changes that were last year, interest rates being a little bit more expensive now than they have been for some time. They will be looking at evaluating their portfolio and considering their options. If they do decide to sell, those that are experienced portfolio landlords that do it full time, perhaps with already established portfolios, will be looking to acquire those assets. Quite interestingly, at the moment, you may be thinking, or the perception or market sentiment could be that nobody is buying. However, when we look at Landbay's volume, the majority of our new business is purchase activity. So people are still acquiring property, much to perhaps what some people may be thinking. So the market is going through some sort of a change, a little bit of a shift. People have gone through the period of believing interest rates are going to be 6, 7, 8%. Nothing's going to stack up. They've reduced significantly. People are starting to accept that that's where we are at. And certainly, for all intents and purposes, I feel the market is very much open, and that's what I'm seeing.
Interesting you say that, because we are seeing similar within our business, because the purchases are steady in some respects. Last month's inquiries, we did see a bit of a spike, and I think the professional landlords are seeing that they know it's not they're not in it for the quick wins, and they are, and as long as it makes sense at the time of purchase, and they're doing a forecast over a number of years, and it makes sense. Yes, the margins have been eaten up significantly because of the rate changes, but if it does stack up, there's the equity growth within the property, within the assets, but also obviously they're looking longer term, that if it does reduce further, then their profits are only going to increase, but it stacks up at day one, even at reduced levels. But which also brings me slightly onto, because we get a number of people, some are serial landlords and significant portfolio landlords, and some are relatively new in the game. So a lot of the people are seeing, interest rates have shot up. The volatility has been tremendous and causing a huge amount of aggravation for a number of people. But can you just give a very high level understanding of, people say, the rates had to go up because of swap rates. That was banded around a lot of times, but yet, and the volatility of the swap rates have gone up, interest rates have gone up, yet the fixed rates have now started to creep down. Can you just give my listeners a bit of an overview on that very high level?
So I think we could probably do a separate session on economic swap rates and the differences between swaps and Bank of England base rate. But very broadly speaking, an interest rate swap and the swap rate is kind of a benchmark that the lender will use when pricing their products. And way back when, an interest rate swap may vary by 0.01 per day or 0.05 per day, but you're talking quite predictable minor adjustments, plus and minus. However, for the last year or so, through a variety of economic factors, what's going on overseas in Russia and Ukraine, political uncertainty, and the mini budget that happened in September has caused these incredible increases in swaps. And what that does is it makes it very difficult to price a product. So you find that lenders are having to factor in a big sway when they are offering a 2-year, a 5-year, a 7-year, a 10-year deal. So it's been very difficult. I'm very glad that I don't work in our pricing department, because there'll be a lot of head scratching going on and competitor analysis. But as we speak today, swaps have started to creep up again. 2-year at the time of us doing this on the start of March is around 4.5%, I believe, and 5-year being around 4%. And just for context, 12 months ago, a 5-year swap was around 1.5%. So it's increased significantly, which is why you're seeing interest rates more than they were 12 months ago. However, you'll see products that are being offered to market that are very similar to the current swap. There's the way that lenders are looking at it now is we're making less margin above what we are paying for the money. And so you're seeing product fees increase to still make it commercially viable for the lender, and the APR palatable for the borrower. Of course, stress testing is often linked to the interest rate. So we want to make sure we're offering a product with a low APR if we can, so the stress rate and the affordability can be its most generous. But perhaps a podcast on its own around that. But
absolutely, we will consider it, and not my field of expertise, but certainly you are well versed in it. But I do think there are a number of sector changes. I mean, personally, we saw development finance a cliff in November. We were getting a number of inquiries, and now, although some people with the planning, etc., having to be almost forced to carry it out, but the numbers still work. But it's a very difficult sector. I'm just interested in 2022. There was a huge surge, noticeable surge in HMOs, right? House of multiple occupancy, and it was almost in fashion. It was to have one was being in fashion at the time of doing that. Do you see that bubble has burst? Still opportunity in it? because there are a number of factors. Obviously, the pricing is evident, but the yields for an HMO is usually significantly higher, but obviously much more maintenance. We can have a whole podcast on the HMOs as we're talking. I'm thinking about, okay, that's the next podcast. But I think, with just utilities, etc. But I'm just interested to know, for anybody who does listen to this, that what's your take on the HMOs, and has it increased, decreased, or stayed the same?
So I see some contradicting comments about HMOs. Some people saying that the bubble has burst through a combination of utilities increasing at a rate of knots that I can't keep up with. Also, single banding was going around. That was kind of a big thing where councils or the VOA, the Valuation Office Agency, were looking at larger HMOs that perhaps had en suites and maybe kitchenettes as well. They were looking at charging council tax on a room by room basis rather than the entire property. That was creating some nervousness amongst certain individuals on certain forums and groups and roadshows and so on. Personally, I think it's still a massive opportunity. And if we look at the data that we can get access to, we're seeing a lot of intermediaries, so people like yourself, Mayor, requesting quotes from product sourcing systems. So clearly there is still a market for HMOs. I did see some stats earlier, I think this week or last week, to say that HMOs reduced by 2.4% last year, so year on year, 2021 versus 2022. So that could indicate that, I wouldn't say the bubble has burst, because a 2% reduction is not a burst of a bubble. That's a tiny little blip there. But I expect that would be people worried about rising costs when, bigger landlords who have been operating in this market for a long time can just look at ways to mitigate things like rising costs, utilities going up. They can introduce sub-meters, Hive, make sure they speak to their tenants about fair usage. It's still an attractive property. It's still a fantastic way to improve your yield versus a standard buy to let. We still get a lot of HMO business. I live in a university town in Norwich. Norwich is booming for HMOs. I still deal with them by the bucket load. I'm certainly not seeing that bubble bursting. We've just launched a little shameless plug here. We've just launched first-time landlord HMO products. So we're seeing investors still wishing to purchase bricks and mortar to invest their hard-earned money, but rather than looking at a vanilla buy-to-let, they are considering HMOs. So we're funding those options. So if you are an inexperienced landlord wishing to invest, there are funding options now for first timers getting into HMOs. So going back to your question, I don't think the bubble's burst. I still think it's a real hot property and asset class. Just requires a little bit more thought.
Fantastic. I think you did actually say, and the information you're going with, you said, I want a subtle plug. The truth of the matter is, and I want to touch upon this to all brokers out there, business development managers, our BDMs, are absolutely critical. Alex will know all too well, I think he'll get an injunction for me stalking him. But any deal that we've got, even if it is a vanilla product, the placement that seems just straightforward, one of my team will just let him know this is coming, because he will ask, he could do a quick Google search on the property, the area, and things like that, and prompt questions that one of my team might have missed. And I just think the relationships of a BDM is absolutely invaluable and has helped us many a time. So, Alex, I really appreciate your time. I mean, go for it. Now is the time. Landbay has been a part of our journey. And what is the pierre de resistance of Landbay? Why are people using you?
So we exclusively lend to landlords. That is our bag. We don't deal with bridging. We don't deal with semi-commercial, commercial, or owner-occupied mortgages. We have only ever dealt with buy-to-let. So we kind of like to think that we know a thing or two about buy-to-let. So we like portfolio landlords. We also like first-time landlords. We can deal with properties that are perhaps a little bit more complicated than you would find if you try to place a deal with a high street lender. They could be flats above certain types of commercial, like offices or retail, or maybe even a nice restaurant or a little boutique coffee shop. They can be difficult to place. But quite often the biggest USP is the service and the relationships that we have. So just going back to your point, Mayor, if you have a deal and you need to speak to somebody and you need to speak to somebody who knows what they are doing, engage with us. Call me and we will talk it through and make sure it stacks up. You know, it may look vanilla on face value, but it's always just worth making sure it's definitely going to stack and fit. You know, there's nothing worse than having a case come in and weeks later, you know, a question rears its head that blows the deal out or makes it no longer feasible. So I like to feel like the service that we provide sets us a cut above the rest. But as always, I value your business, Mayor, and hopefully, you know, long may our relationship continue.
I'm sure it will. Alex, really appreciate your time. Thank you for joining me on the first ever podcast. Have to say this because under FCA, I think about it every single moment, but nothing in these podcasts will be constituted as advice to you personally. Please give us a call and hopefully we can sort out any of your problems or questions. As all my LinkedIn posts end, I've set this out to assist, and my strapline is here to help. And that's exactly what we're doing. Thank you so much for joining us and look forward to our next podcast. Critique this. It's my first time. Let me know what you think. Any suggestions, any questions, we'll formulate that and hopefully develop that accordingly. Thank you very much. Once again, Alex Witham from Landbay, thank you for your time.
Thank you.